March 18, 1975. A decision was made in Kuwait City that would reshape the financial landscape of the Middle East forever. On this day, the Central Bank of Kuwait announced that the Kuwaiti Dinar would no longer be tied to the British pound. Instead, it would be pegged to a weighted basket of international currencies. Within months, something extraordinary happened. The Kuwaiti Dinar became the world's most valuable currency, surpassing the British pound, the US dollar, and the Swiss franc. Today, in 2025, one Kuwaiti dinar is worth $3.26. It has held the title of the world's highest valued currency for 5 decades. But this story doesn't begin in 1975. It begins in a desert, with black patches on the ground that nobody understands. In the early 1920s, Kuwaiti Bedouins had long noticed peculiar black deposits scattered across the desert. These rough, bituminous substances seemed worthless. Kuwait at the time was a modest sheikhdom under British protection, its economy built entirely on pearl diving, fishing, and trade. The country had no agriculture, no industry, and no natural resources beyond its strategic location at the top of the Persian Gulf. But Sheikh Ahmad al-Jaber al-Sabah, who became ruler in 1921, saw possibilities where others saw nothing. He kept his faith in the future, even as the cultured pearl industry destroyed Kuwait's main source of income in the late 1920s, even as the Great Depression crushed global trade in the 1930s. Those black patches in the desert might be something more. In 1934, Sheikh Ahmad signed a document that would change everything. The Kuwait Oil Company was formed by the Gulf Oil Corporation and the Anglo-Persian Oil Company. They began drilling. On a rainy Thursday morning at 11 a.m., oil burst through the wellhead valve at Burgan Field, one with such force that it couldn't be controlled. The pressure was immense. The quantity was staggering. Workers scrambled to find anything to plug the well. Donald Campbell, the chief accountant, finally located a 60-foot wooden pole in the town bazaar. It served as a temporary stopper. The Burgan Field was estimated to hold 66 billion barrels of crude oil. It was the second largest oil field ever discovered. Kuwait, which just yesterday had been struggling to survive, was now sitting on one of the world's greatest petroleum reserves. But World War II delayed everything. For 8 years, the oil stayed in the ground. Kuwait waited. June 30th, 1946. Sheikh Ahmad al-Jaber al-Sabah turned a silver wheel at a ceremony attended by senior officials and distinguished guests. Kuwait's first crude oil shipment began flowing smoothly through an offshore pipeline to the British tanker Fusilier. In 11 hours and 13 minutes, 10,567 tons of crude oil were loaded, an average of 950 tons per hour. Kuwait had joined the ranks of the world's major oil producers. The transformation was immediate and overwhelming. Oil revenues flooded into a country that had no infrastructure to handle such wealth. In the 1950s, Kuwait went from being one of the poorest nations on earth to one of the richest. By 1951, Kuwait's oil production had surpassed even Saudi Arabia. The economy exploded. GDP skyrocketed. The government suddenly had more money than it knew how to spend. This is when Kuwait made a decision that would prove absolutely critical to the dinar's future dominance. In 1953, 8 years before independence, Sheikh Abdullah al-Salem al-Sabah established the Kuwait Investment Board in London. Its purpose was simple but visionary: manage the financial surpluses from oil before they corrupted the economy. Save for future generations. Don't waste it. This was the Kuwait Investment Authority in its infancy, the world's first sovereign wealth fund. Today, 72 years later, it manages over $1 trillion in assets. Kuwait gained full independence from British protection. The government faced an immediate challenge: What currency should represent this new nation? Kuwait had been using the Gulf rupee, which was pegged to the Indian rupee. This wouldn't do. A sovereign nation needed its own currency. The Kuwaiti currency law was passed in 1960. The Kuwaiti Currency Board was established. And on April 1st, 1961, the first series of Kuwaiti Dinar banknotes entered circulation. The exchange rate was set at 1 dinar equal to 1 British pound sterling. At the time, that meant 1 dinar was worth $2.80 US. The conversion from rupees was brutal, 13 1/3 rupees to 1 dinar. But Kuwait wasn't concerned with making the math easy. They wanted a strong currency that reflected their newfound wealth. The coins featured a boom ship on the obverse side, a tribute to Kuwait's history as a shipbuilding center in the Persian Gulf. The message was clear. We remember where we came from, but we're going somewhere greater. In 1969, the Kuwaiti Currency Board was replaced by the Central Bank of Kuwait, giving the young nation full monetary authority. The dinar's journey toward becoming the world's most valuable currency had begun. By 1975, the global monetary system was in chaos. The Bretton Woods Agreement had collapsed in 1971, ending the dollar's convertibility to gold. Currencies were fluctuating wildly. The British pound, to which the dinar was still pegged, was losing value against other major currencies. Inflation was becoming a serious concern across the Gulf. The Central Bank of Kuwait faced a critical decision. They could maintain the pound peg and watch their currency weaken along with Britain's declining economic power. Or they could try something different, something no other Gulf nation had attempted. On March 18th, 1975, the announcement came. The Kuwaiti dinar would be pegged to a weighted basket of currencies from countries that had significant trade and financial relations with Kuwait. The US dollar, British pound, Japanese yen, and other major currencies would all factor into the dinar's value. The exact weights would remain undisclosed. The effect was immediate and dramatic. By diversifying its currency anchor, Kuwait gained something its neighbors didn't have: flexibility. When the dollar weakened, the dinar didn't fall with it. When the pound collapsed, the dinar held steady. The basket absorbed shocks from any single economy. Within months, the Kuwaiti dinar's value had risen above the British pound, the US dollar, and the Swiss franc. It became the world's most valuable currency, a position it has never relinquished. Other Gulf nations watched in amazement, but they didn't follow Kuwait's lead. Saudi Arabia, the UAE, Qatar, Bahrain, and Oman all chose to peg their currencies directly to the US dollar. They wanted the simplicity and stability of a single anchor. Kuwait alone kept the basket. This decision would prove crucial in the decades to come. Why is the Kuwaiti dinar so valuable? The answer isn't just oil wealth. Bahrain, Oman, Saudi Arabia, Qatar, and the UAE all have massive oil reserves too, yet their currencies aren't as valuable as the dinar. The secret lies in supply and demand, carefully managed by the Central Bank of Kuwait. Kuwait holds approximately 7% of the world's proven oil reserves, about 101.5 billion barrels. The country produces 2.7 million barrels per day, with remarkably low production costs. The break-even price is around $40 to $50 per barrel, far lower than most oil-producing nations. This means Kuwait profits even when global oil prices are depressed. But the critical difference is this: Kuwait has a relatively small population, just 4.2 million people, of which only about 1.2 million are Kuwaiti citizens. The rest are expatriates. Oil exports account for over 90% of government revenue. That revenue is divided among far fewer citizens than in larger Gulf states. The result is one of the highest GDP per capita figures in the world, around $80,000 per person in purchasing power. More importantly, The Central Bank of Kuwait has deliberately kept the money supply tight. They don't print dinars carelessly. The currency is scarce, and scarcity drives value. Saudi Arabia, Qatar, and the UAE, despite their wealth, have much larger currency supplies circulating in their economies. More units mean a lower value per unit. Kuwait also benefits from having virtually no public debt. The government runs budget surpluses most years. When deficits do occur, they're covered by withdrawals from the Sovereign Wealth Fund, not by borrowing. No interest payments are draining the national budget, no bondholders demanding repayment. The fiscal position is rock solid. The Sovereign Wealth Fund itself provides a massive cushion. With over $1 trillion in assets, the Kuwait Investment Authority can intervene in currency markets whenever necessary to defend the dinar's value. They have essentially unlimited firepower. August 2nd, 1990. Iraqi forces invaded Kuwait under orders from Saddam Hussein. Within 2 days, the country was fully occupied. Saddam's ambitions were clear: annex Kuwait, control its oil fields, and dominate the Middle East. The invasion had immediate consequences for the Kuwaiti dinar. Iraqi authorities declared the dinar equal in value to the Iraqi dinar, slashing its worth to 1/12 of its actual value overnight. Iraqi troops looted the Central Bank of Kuwait, stealing over $1 billion in banknotes and $400 million in gold. The stolen currency flooded into circulation. Kuwaitis were forced to use Iraqi dinars. Merchants had to accept the worthless notes or face violence from occupying forces. The banking system collapsed. Kuwait's financial infrastructure, built up over 3 decades, was systematically destroyed. For 7 months, the Kuwaiti dinar ceased to exist as a functioning currency. On September 30th, 1990, the Kuwaiti government in exile made a bold decision. They declared all stolen banknotes invalid. The government maintained detailed records of every serial number taken from the central bank. Any note with those serial numbers would not be honored. Iraq's looted money was worthless. The decision infuriated Kuwaiti merchants, who had been forced to accept the stolen notes during the occupation, but it sent a clear message: Kuwait would not allow its currency to be a tool of invasion. February 28, 1991. Coalition forces liberated Kuwait after Operation Desert Storm. The country was devastated. Oil fields were set ablaze. Infrastructure was destroyed. The economy was in ruins. But on March 24, 1991, just 24 days after liberation, the Central Bank of Kuwait took unprecedented action. They reintroduced the Kuwaiti dinar with a new exchange rate. 1 dinar equal to $3.47 This was a significant increase from the pre-invasion rate of approximately 30 cents per dinar. Wait, the pre-invasion rate was 30 cents? How is that possible if the dinar was already the world's most valuable currency in 1975? The answer lies in a technicality that confuses many people. Currency value is measured in multiple ways. The nominal exchange rate, what most people think of as a currency's value, is actually not the most important metric. What matters more is purchasing power and stability. Throughout the 1980s, the dinar's purchasing power remained extraordinarily high, even as its nominal dollar rate fluctuated. After liberation, Kuwait's revaluation to $3.47 was a statement to the world. We are back, we are strong, and our currency will remain the most valuable on earth. The government introduced the 4th series of Kuwaiti dinar banknotes. The old series was completely demonetized, rendering all stolen notes useless. New security features were added. The design celebrated Kuwait's resilience and rebirth. Within months, the banking system was restored. The Sovereign Wealth Fund, which had been protected in foreign investments during the occupation, remained intact with hundreds of billions in assets. Kuwait's economy began recovering at a remarkable pace. In 2003, Kuwait made a surprising decision. After 28 years of using a currency basket, they switched to a dollar peg, just like their neighbors. The exchange rate was fixed at 299.63 fils per dollar, with margins of plus or minus 3.5%. The reason was simple. The Gulf Cooperation Council was planning to introduce a single currency by 2010. All 6 member states needed to harmonize their monetary policies. A common dollar peg was the first step toward monetary union. For 4 years, Kuwait's dinar followed the US dollar's every move. When the dollar rose, the dinar rose. When the dollar fell, the dinar fell with it. But something went wrong. Between 2003 and 2007, the US dollar depreciated sharply against major currencies like the euro and the yen. Kuwait's real effective exchange rate, the measure of the dinar's value against all its trading partners' currencies, began to fall. Imported goods became more expensive. Inflation started to rise. By 2007, inflation in Kuwait was approaching uncomfortable levels. The government tried everything to cool down price increases. But as long as the dinar was tied to a weakening dollar, there was little the central bank could do. Interest rates had to follow the US Federal Reserve's decisions, even though Kuwait's economy needed different policies. On May 20th, 2007, Kuwait made a historic announcement. They were abandoning the dollar peg and returning to a currency basket. The decision was immediate and unilateral. They didn't wait for other GCC nations to follow. They didn't ask for permission. They simply did what was best for Kuwait's economy. The stated reason was clear: to contain inflationary pressures caused by the dollar's prolonged depreciation. Kuwait needed to protect the purchasing power of its national currency. The other Gulf states were shocked. The entire monetary union plan was thrown into doubt. If Kuwait didn't maintain a dollar peg, how could a single GCC currency work? Saudi Arabia, the UAE, Qatar, Bahrain, and Oman all kept their dollar pegs. Only Kuwait broke ranks. The immediate effect was a revaluation of about 1%, small on the surface but symbolically enormous. Kuwait had reasserted its monetary independence. The central bank gained the flexibility to fight inflation, adjust interest rates, and manage the economy without being constrained by US policy decisions. More importantly, the move reaffirmed the dinar's status as the world's most valuable currency. By 2007, 1 dinar was worth approximately $3.40. The gap between the dinar and its nearest competitors, the Bahraini dinar and the Omani rial, widened even further. Today, in 2025, the Kuwaiti dinar remains firmly at the top. 1 dinar equals $3.26, while the Bahraini dinar is worth $2.65, and the Omani rial is $2.60. The dream of a single Gulf currency died slowly. Oman opposed the public debt limits required for integration. The UAE objected to Saudi Arabia's proposed dominant role in the regional central bank. Kuwait's refusal to maintain a dollar peg made coordination nearly impossible. By 2010, the deadline had passed with no union. Today, 15 years later, the idea is essentially dead. Each Gulf nation maintains its own currency, its own monetary policy, and its own central bank, and each has chosen its own path. Saudi Arabia, with its 3.75 rial to the dollar peg, prioritizes stability for its massive oil export economy. The UAE, Qatar, and Bahrain have similar strategies. Oman adjusts its peg occasionally but stays dollar-focused. Only Kuwait maintains the basket. This independence comes at a cost. Kuwait can't leverage the economic weight of a unified Gulf bloc. They can't coordinate monetary policy with their neighbors during regional crises. When oil prices collapse, Kuwait stands alone. But the benefits are clear. While other Gulf currencies are forced to mirror U.S. interest rate decisions, Kuwait has flexibility. When the Federal Reserve cuts rates to stimulate the American economy, the Central Bank of Kuwait can raise rates to fight Kuwaiti inflation. When the dollar surges and makes exports expensive, the dinar's basket anchor provides a buffer. This flexibility has allowed Kuwait to maintain remarkably stable inflation. Between 2019 and 2025, average inflation has been around 2.3 to 2.4% annually. Compare that to double-digit inflation in many oil-dependent economies during the same period. The difference is monetary independence. Behind the dinar's strength lies an almost incomprehensible amount of money. The Kuwait Investment Authority, established in 1953, manages two main funds. The General Reserve Fund holds Kuwait's oil revenues and can be used for budget support during lean years. The Future Generations Fund is untouchable, designed to provide for Kuwaitis long after the oil runs out. In February 2025, the Kuwait Investment Authority surpassed $1 trillion in assets under management for the first time in its history. It is the fifth largest sovereign wealth fund in the world, behind only Norway, China, the UAE, and Saudi Arabia. By law, Kuwait is required to deposit 10% of annual oil revenues into the Future Generations Fund during surplus years. This discipline has created a massive nest egg. Even during budget deficits, the government can draw from the General Reserve Fund rather than borrowing. Kuwait maintains one of the strongest fiscal positions in the world. The KIA's investment strategy is global and diversified. Major stakes in Citigroup, Bank of America, and BlackRock. Significant real estate holdings in London, including landmarks in Canary Wharf and the City, investments in Chinese banks, European infrastructure, and emerging market equities. The fund's reach extends to every corner of the global economy. This diversification provides multiple benefits. First, it generates returns even when oil prices fall. Second, it gives Kuwait enormous soft power in international finance. And third, it creates a massive cushion for the dinar. If speculators ever tried to attack the Kuwaiti currency, the KIA could deploy tens of billions of dollars within hours to defend it. No currency trader in their right mind would bet against a country with $1 trillion in foreign assets. The dinar is essentially bulletproof. But beneath this success story lies a fundamental weakness that Kuwait has never fully resolved: economic diversification. Oil and gas account for over 90% of government revenue, over 80% of export earnings, about 43% of GDP. When oil prices rise, Kuwait thrives. When they fall, deficits emerge despite the massive sovereign wealth fund. Since 2016, Kuwait has run budget deficits in most years. The government has tried to issue debt to finance spending, but political gridlock in the National Assembly has repeatedly blocked debt issuance. This forces withdrawals from the General Reserve Fund, slowly draining the buffer between Kuwait and a fiscal crisis. In 2025, S&P Global projects Kuwait's fiscal deficit will average 8.9% of GDP between 2025 and 2028. That's unsustainable in the long term, even with $1 trillion sovereign fund. The Future Generations Fund is protected by law, but the General Reserve Fund is not. If deficits continue for another decade, the reserves could be depleted. Kuwait's government has launched Vision 2035. An ambitious plan to diversify the economy into logistics, finance, tourism, and clean energy. The Northern Gulf region is being developed as a commercial hub. New refineries and petrochemical plants are being built. The country is investing in solar energy and renewable infrastructure. But progress is slow. The public sector is bloated with regime loyalists. Private sector competitiveness has atrophied. Most technical and specialized positions are filled by expatriates rather than Kuwaiti nationals. Economic reforms face fierce political resistance. The warning sign is clear. If Kuwait doesn't diversify away from oil dependence, even the world's most valuable currency could face pressure in the decades ahead. What can the rest of the world learn from Kuwait's currency success? Several lessons stand out. First, scarcity matters. Kuwait has deliberately kept its currency supply limited relative to its wealth. Other nations, especially developing economies, often print money freely to finance government spending, causing inflation and currency depreciation. Kuwait's discipline in monetary policy has paid enormous dividends. Second, diversification reduces risk. The currency basket peg has given Kuwait flexibility that dollar-pegged nations lack. When crises hit, Kuwait can adjust its monetary policy independently. Other Gulf states are locked into U.S. Federal Reserve decisions, even when those decisions hurt their economies. Third, long-term thinking beats short-term spending. The Sovereign Wealth Fund, established 72 years ago, has grown into a financial fortress. Kuwait saved for future generations, instead of consuming all its oil wealth immediately. Many resource-rich nations, from Venezuela to Nigeria, failed this test and now face economic crises. Fourth, currency value doesn't equal economic power. The Kuwaiti dinar is the world's most valuable, but Kuwait is not the world's largest economy. The dinar doesn't rival the dollar in global trade. It doesn't need to. Kuwait has carved out a specific niche: high value per unit, tight supply, strong reserves, and a focus on protecting purchasing power for its citizens. And fifth, resource wealth is both a blessing and a curse. Kuwait has avoided the worst aspects of the resource curse, but hasn't escaped entirely. Economic diversification remains elusive. The private sector is weak. Innovation lags. Future prosperity depends on breaking oil dependence, but the currency's strength makes that transition harder. The Kuwait Dinar's story isn't over. In many ways, it's only just beginning. The easy part, riding oil wealth to currency dominance, is behind them. The hard part, building a sustainable economy without oil, lies ahead. Whether the Kuwaiti dinar remains the world's most valuable currency in 2075 depends on the choices Kuwait makes today. One thing is certain: the world will be watching. And the lessons from Kuwait's success and its struggles will shape how resource-rich nations think about wealth, currency, and the future for generations to come.